Joining us now, Robert Heller, former Federal Reserve Governor. Governor Heller, welcome. It's always good to see you. What is your reaction to what the Fed did and what it said in its statement?
No great surprise for me. Everybody expected 25 basis points as the Fed is slowing down its tightening process. The big question is whether they're really done or not. If you look at the money supply, which is a very important variable that the Fed does not tend to look at, it's actually negative. So that is another indicator, in addition to the inverted yield curve, that the economy is slowing down and that we will be facing a recession in the middle of this year.
So that is your base case, is that there will be some sort of recession by mid-year. Does that then argue that the stock market has got it wrong? The market has been rising here for the past 3 or 4 months generally, and it had put in a very nice month of January. Do you expect that to cease if, as you just said, the telltales of recession become more evident?
Well, Tyler, we all agree the markets tend to be forward-looking, and in a forward-looking market, they may have priced in that small recession already. Mm-hmm. I'm not the great stock market guru that a lot of the other guests are, but I would see the stock market improving as a very positive sign that the recession will be relatively mild and not of a long duration.
What's going to happen to inflation, you think?
Inflation will continue to come down. And the reason for that is, again, that we see the money supply shrinking at the present time. It's going down, and that is still the best indicator for inflation. Half a year, year and a half in the future. So inflation will be more contained.
Talk to us a little bit, if you would, about the tightening of Fed policy with respect to its balance sheet and how important that is. Even after the Fed stops raising interest rates, presumably they will continue to reduce their balance sheet by selling into the market the securities that they own. That is another form of tightening, isn't it?
Exactly. And it's very important. But here you also bring then up implicitly the government policy. The Federal Reserve has financed the enormous increase in the federal deficits in the past. And that was, in my view, a mistake. But now we need the federal government to also tighten, to stop spending, to have smaller deficits. And that will help monetary policy to achieve the goals that we all have. So the ball is really in the congressional and the administration realm. There we got to see the tightening and have good fiscal policy so that the debt doesn't continue to increase, which is now at more than 100% of GDP. These are levels
well
at which
over 100%.
used to go broke.
It's no problem. We'll just hit the debt ceiling. It'll be fine. That's how we'll stop it. Serious question. What do you think is the lag with which monetary policy hits the economy? Because I often wonder when we're talking about the market pricing in this versus that, let's say the market sees 3 to 6 months out, but monetary policy is going to hit 12 to 18 months from now. Is there a mismatch there that the stock market can't quite see around the corner of what's coming? And didn't we see that where the biggest expansions in NGDP were probably at the end of 2021, even though a lot of the stimulus hit in March of 2020, maybe January of 21? What's the lag that you think we should expect for all of the rate hikes that we're experiencing right now?
Well, that's a very tough question. Milton Friedman would answer, the lags are long and variable. And I think he was a very, very smart man. So monetary policy lags, I would say, are between 12 and 18 months in that ballpark.
12 to 18 months still. So you just wonder, can the market really see that far ahead? Maybe the bond market can, but I wonder about stocks.
Well, there are a lot of smart people in the stock market. There's money to be made. Whoever gets it right makes the most money. Yeah. So it's a self-correcting scheme in a way. typically, I think the markets do not look that far ahead. They want to see sort of what is just in front of the windshield. Is it raining? People in the market will get a bit more depressed. But so you may well be right that the lags are different between the stock market and the monetary policy.